let's talk about the US stock market. It's one of the biggest in the world, right? But how do you actually go about investing in it? Well, that's what we're going to talk about in this video, so make sure to stay tuned and let's get started. So why should you even invest in the first place? Well, stocks have historically outpaced inflation around 8% per year on average, and the stock market has grown faster than any other asset class. Now, there will be bumps on the road, but if you're thinking long-term, stocks are generally a pretty good bet. Now, when we're talking about investing in the stock market, we're mostly talking about the two big exchanges, the New York Stock Exchange and the Nasdaq. Together, these markets are worth over $50 trillion, making it one of the biggest in the world. The NYSE is probably the most famous exchange in the world. It's where you'll find the biggest publicly traded companies. The Nasdaq is mostly known for its technology stocks. It's also known for being a lot more volatile than the S&P 500. One of the questions we get all the time is, can you time the market? That is, can you buy in at the lowest possible point to get the highest returns? Well, it turns out that no one really knows. Most of the time, even the pros get it wrong. What they do know, though, is that staying in the market consistently does yield higher returns over time. So our recommendation is always to buy and hold. We'll talk more about that later. But for now, let's discuss some basics. What is a stock? Simply put, it's a piece of ownership in a company. When you buy a stock, you become a shareholder, which means you own a tiny piece of that company. But keep in mind, you don't own the physical product. It's just a piece of paper. There are two types of stocks, common and preferred. Preferred stockholders receive dividends before common stockholders, but they typically don't have voting rights. Common stockholders, on the other hand, might receive dividends, but that isn't guaranteed. Common stockholders also have the right to vote on major corporate decisions. Next up, let's talk about dividends. That's a payment made by a company to its shareholders. Typically, these are paid out of the company's profits, but they aren't required to pay them. Some do, some don't. The payments are usually in cash, but sometimes companies will offer more shares of stock as a dividend. And finally, there's capital gains, which is the profit you make from selling your shares for more than you bought them. Now, keep in mind, this is only realized profit. You'll only actually make that money once you sell your shares. There are two ways to buy and sell stocks. The first way is called a market order. And when you do this, you're telling your broker to buy or sell the stock immediately at the current market price. There's no waiting around for a better deal. You just want to buy it now. The second option is called a limit order. With this type of order, you tell your broker at what price you want to buy or sell the stock. Let's say you think that a stock is going to drop in price. So you want to set a limit order to sell your shares at a certain price. If that price is met, then your shares will be sold. But if it's not, then the trade won't happen at all. Before you jump into the market, it's important that you educate yourself on the basics. Knowing the language of investing will make everything a lot easier to understand. If you're looking to get started, there are a few things that you should do first. First, you want to evaluate your finances and make sure that you're ready to invest. Do you have an emergency fund? Do you have any high-interest debt? These are all important questions that you need to answer before you start investing. Once you've done that, you need to open a brokerage account. We like to use one that offers low commissions and a wide range of investment options. And finally, you need to decide how much money you want to invest. And don't worry, you don't need a lot of money to start investing. Many brokerages allow you to invest in fractions of shares. so you can start investing with as little as $1. Now that you're ready to invest, you need to develop a strategy. This is how you'll decide which stocks to buy and when to sell them. There are a number of different strategies that you can use. The most popular one is called indexing. Index investing is when you buy a basket of stocks that tracks the performance of a particular market. For example, the S&P 500 is an index that tracks the top 500 companies in the United States. When you invest in an S&P 500 index fund, you're buying a piece of all of those 500 companies. This is a great way to get started because you don't have to pick individual stocks. It's like investing in the entire market at once. Index funds are also a great way to save on fees. Because you're buying a basket of stocks, you don't have to pay a commission every time you buy or sell. And since index funds are so popular, there are a number of different options to choose from. Each one will have its own fee schedule. So be sure to read the fine print before you invest. Another popular strategy is value investing. This is when you look for stocks that are trading below their intrinsic value. Intrinsic value is the true value of a stock. It's based on the company's fundamentals, things like its earnings, its debt, and its assets. Value investors look for stocks that are trading below their intrinsic value because they believe that the market will eventually correct itself. This means that the stock price will go up to reflect the company's true value. If you're interested in value investing, you'll want to use fundamental analysis to find stocks that are undervalued. This involves looking at the company's financial statements and other public data to get a sense of the company's financial health. You'll want to look at metrics like price-to-earnings ratio, dividend yield, and debt-to-equity ratio. Once you've found a stock that you think is undervalued, you'll want to hold on to it for the long term. Value investing is a long-term strategy, and you don't want to sell your stock too early. The next strategy is growth investing. This is when you look for stocks that are growing faster than the overall market. Growth investors are typically willing to pay a premium for these stocks because they believe that the growth will continue. If you're interested in growth investing, you'll want to use technical analysis to find stocks that are on an upward trend. This involves studying the stock's price history to identify patterns and predict future price movements. You'll want to look at metrics like moving averages, relative strength index, and volume. Once you've found a stock that you think has growth potential, you'll want to hold on to it for the short to medium term. Growth investing is a short-term strategy, and you want to hold on to your stocks for too long. The final strategy is dividend investing. This is when you look for stocks that pay a high dividend yield. Dividend yield is the annual dividend payment divided by the stock price. Dividend investors typically don't care about the stock price going up or down. They just want a steady stream of income from the dividend. If you're interested in dividend investing, you'll want to look for stocks with a history of paying dividends and increasing them over time. You'll also want to look for stocks with a low payout ratio. The payout ratio is the percentage of earnings that are paid out as dividends. A low payout ratio means that the company has more earnings available to reinvest back into the business and grow. No matter which strategy you choose, it's important to be disciplined and stick to your plan. It's also important to be patient. Investing takes time, and you won't get rich quick. As you're investing, you'll want to monitor your portfolio and make sure that it's still aligned with your goals. This means rebalancing your portfolio and harvesting tax losses. Rebalancing is when you sell some of your investments and buy others to bring your portfolio back into line with your goals. Harvesting tax losses is when you sell your losing investments to offset your capital gains. This can help you reduce your tax bill at the end of the year. In 2025, the stock market is expected to be volatile. There are a number of different factors that could cause the market to go up or down. This means that you need to be prepared for anything. Having a plan in place will help you stay on track and make smart investment decisions. For example, if the market starts to decline, you might want to buy more stocks. This is because stock prices tend to go back up over time. On the other hand, if the market is on the rise, you might want to sell some of your stocks and take profits. No matter what happens, it's important to stay calm and stick to your plan. Here are a few more tips for success. First, diversify your portfolio. This means investing in a variety of different stocks across